Welcome to The Explainer. Today, we're taking a really hard, focused look at a financial phenomenon that is just sweeping the nation right now. And honestly, it's emptying pockets at an alarming rate. We're going to break down the actual anatomy of a trading trap. If you've ever been tempted by those flashy green and red charts on your phone, or if you've just wondered how the markets truly operate behind the scenes, well, you really need to hear this. We're unraveling the deep mysteries of modern trading. And trust me, the truth is stranger and a whole lot more ruthless than fiction. You know, it almost always starts with a hook. Something like, earn 50,000 rupees in 5 minutes with this secret. And this is exactly the kind of thing that caught the eye of Ramesh, a 19-year-old college kid. Picture him just lying in his hostel bed, scrolling through videos online. He felt like everyone around him, his parents, his friends, were just running the wrong race, working day and night for absolute peanuts. He really wanted to escape poverty and give his family a luxurious life. So he tried options trading. And after a couple of small, lucky wins of 600 and 1,200 rupees, his confidence absolutely skyrocketed. He became convinced he had cracked the code to easy wealth. So he took a massive leap. He took his hostel and college fees, money his parents had literally worked tirelessly to save, and he put the whole shebang into one big trade. He's sitting there, right? Intensely watching the screen as the candles blink. Green, then red, green, then red again. And then, just a sudden massive crash in the graph. In mere seconds, his balance hit zero. His heart is pounding, hands shaking, sweat dripping down his forehead. Every single rupee of his parents' hard-earned savings was just gone. Just like that. The dream turned into an absolute nightmare in the blink of an eye.
Let's move into part 1, the bitter truth of trading. Because unfortunately, Ramesh is far from alone in this. When we pull back the curtain and actually look at the official government data, the sheer imbalance is just staggering. 93% of retail traders are losing money. Let that sink in. 9 out of 10 average people fail in the derivatives market, specifically in futures and options. We are talking about more than 1 crore retail traders taking an average loss of over 2 lakh rupees each. That is a massive wealth wipeout for the everyday citizen. And we really need to look at what is actually happening behind the screens of those highly addictive trading apps. Now, to really wrap your head around the sheer scale of this madness, just look at the daily volume. The daily turnover in the regular Indian equity market, where you buy and hold actual company shares, is a massive 1 lakh crore rupees. But the futures and options, or F&O market, it sits at a staggering 330 lakh crore daily. The derivatives market is literally 330 times larger than the actual equity market. It is an absolute behemoth that is just dominating the financial landscape right now.
So let's dive into part 2, the real history of derivatives. If we trace this all the way back, the timeline actually starts 4,000 years ago in the dusty markets of Mesopotamia. Back then, farmers and merchants made simple forward contracts, basically just agreeing on the price of a crop before it was even harvested. It's an ingenious practice that survived the fall of the Roman Empire, was used by Byzantine traders, evolved significantly during the Renaissance in Amsterdam, and has now exploded into 2023, where modern India has remarkably become the world's largest derivatives market. To fully grasp how we got to this frenzied state, we kind of have to strip away all the modern jargon and the flashing app interfaces.
So the crucial starting point is understanding the core concept. What actually is a derivative? Well, its value is derived from an underlying asset. Think of that ancient farmer's wheat, or today, maybe a barrel of crude oil, or a company stock. The entire point originally was safety. It was designed to help farmers and merchants hedge their risks against sudden, disastrous price drops. It was meant to be a financial shield, guys, not a lottery ticket.
But here is the fundamental mathematical reality of the modern futures market that you absolutely must understand. It operates as a zero-sum game. Wealth is not being created here, like it is when a company grows and its stock price goes up. No, in derivatives, every single rupee a retail trader like Ramesh loses is a rupee directly transferred into someone else's pocket. If you lose, someone else wins that exact amount. Plain and simple.
Building on this, back in the markets of Amsterdam, they introduced a new layer of flexibility, options. A call option gives you the right to buy, and a put option gives you the right to sell an asset at a fixed price. The real innovation here was that you only pay a small premium to hold this right. If the market turns against you, you don't actually have to execute the trade. You can just walk away, losing only that small premium. Which brings us to part 3, from hedging to gambling.
So, how did a mathematical tool designed for safety transform into a high-stakes machine? It all comes down to how different players use the exact same tool. On one side, you have massive financial institutions. They use derivatives exactly as intended to hedge and protect their multi-thousand core mutual fund portfolios from sudden market crashes. But on the other side, you have the retail traders, and they aren't hedging anything. They're using those cheap 20 rupee options premiums to get 50 times leverage on their small capital, hoping to magically multiply their money instantly. They are basically swinging for the fences with every single pitch.
And that leads us to this staggering number, 84.8 billion. That is the number of derivative contracts executed by the National Stock Exchange of India in 2023 alone. It makes India the undisputed global leader in derivatives trading. Yet, the really bitter irony here is that this incredible volume is happening in a country where the overall financial literacy rate is just 27%. We've got millions of people playing a highly complex game they simply do not understand.
The growth curve we're seeing is just explosive. Back in 2019, there were roughly 7 lakh FNO investors. Today, we are staring at 96 lakh. That is an almost 13-fold increase in just a few years. And here is the deeply concerning demographic detail. 43% of these 96 lakh investors are under 30 years old. An entire generation is out there chasing a dangerous illusion of quick wealth, drawn in by the allure of instant leverage. Let's look at part 4. Why do retail traders lose?
If the data is public and the massive losses are well documented everywhere, why do so many people willingly throw their hard-earned money away? The dark truth of why people can't stop is perfectly captured by this student's confession. I am addicted to trading and I'm unable to quit. These are the exact words of a 20-year-old engineering student who somehow managed to rack up a 46 lakh rupee loss while having zero personal income. Zero. He funded this through his parents' money, begging from friends, and using shady loan apps. This isn't about bad financial strategy anymore, guys. This points directly to a severe biological hijacking.
And the ultimate culprit behind that hijacking is dopamine. What is super fascinating is that your brain doesn't just release dopamine when you win. It releases a massive spike of it in the intense anticipation of hitting the jackpot. Modern trading apps know this for sure. With their bright colors, fast interfaces, and one-click execution, they are designed literally just like a casino slot machine. They trigger a dopamine rush the exact moment before the trade, completely overriding your logical decision-making. Now, while your brain is flooded with dopamine, let's take a look at who you are actually fighting on the other side of that trade. It is the ultimate David versus Goliath reality. You are an emotional retail trader, manually clicking buttons on a phone, reacting to red and green colors, and hoping for luck. Your opponent? Cold, calculating institutional algorithms executing thousands of highly calculated trades in mere milliseconds. In fact, algorithms control roughly 70% of the entire market. It is simply not a fair fight. And the mathematical result of that mismatched fight is this: 1.8 lakh crore rupees. That is the massive CB reported loss absorbed by retail traders. And remember our zero-sum game roll from earlier? That 1.8 lakh crore didn't just vanish into thin air. Nope. It went directly into the pockets of those massive institutions running the algorithms, some of which are walking away with 735 crore rupees in pure profit every single day. Finally, part 5, how to escape this trap. Look, if you or someone you know is caught in this vicious cycle, we need to transition from just understanding the problem to actually executing the solution. Here are the 3 absolutely crucial steps to step out of the casino. First, awareness. You must consciously recognize the dopamine loop. Accept that you are dealing with an addictive app design, not just market data. Second, strict risk management. Never, ever trade with money that would ruin your life or your family's life if lost. And third, deep financial literacy. This market is a dense science of data, probability, and global factors. True market success requires immense, dedicated knowledge. Blind guessing is really just happily donating your money to a Wall Street algorithm.
I really want to leave you with this final provocative thought to chew on. The next time you open up a trading app and look at those flashing candles, ask yourself, are you actually building wealth through true tested skill, or are you just gambling on sheer luck? Let that sink in. Understand the game you're playing before you put your future on the table. Thank you for joining me on this explainer. Keep learning, stay focused, and I'll catch you in the next one.